Hello, everyone. My name is Tom Kerr. I'm a senior equity analyst at Zacks Small Cap Research, and welcome to another episode of our Fireside Chat program. Today, we have the CEO of T3 Defense, Menny Shalom. T3 Defense is a global aerospace and defense holding company focused on acquiring and operating mission-critical defense businesses. The company is headquartered in New York City, and currently most of the company's operations are in Israel, but they are looking to expand into other markets. The stock trades under the NASDAQ under the ticker DFNS. We initiated coverage of T3 in June of this year with a price target of $1.50 per share US. Welcome, Menny.
Hi, Tom. Thank you for having us.
All right, let's start off with a few minutes on the background of the company and its history, and that kind of led us to where we are today.
T3 came to the market as Nucleus. Originally, back in December 23, it was a D-SPAC of a failed fintech company. I got the company back in September of 2024, and I announced the first defense deal back in December of 24. It took us quite some time to do the shift. Regulation-wise, operationally, financially, but technically and officially, we started trading as a defense holding company January of this year. That's when we announced the closing of the original acquisition of Rimon. Rimon is a player in the generator and tactical vehicle here in Israel. But we also announced acquisitions of a few other companies, including ITS, Tiltan, and Zornet. So although we are in the market from December of 23, we are in the market as a defense company starting only January this year and going forward.
Got it. Well, let's get into the details of the operating subsidiaries you have now. There's 5, I believe. Actually, there's 6, and we'll talk about that announcement in a few minutes. But maybe start with what you just mentioned, Rimon.
Sure. So Rimon is, as you said, as I said earlier, is with the first acquisition. Rimon is a manufacturer of generators and masts for the defense industry. They are the sole and exclusive provider of the Israeli Iron Dome, which is an anti-missile system sold worldwide, and we exclusively provide the generators for that. We also import and sell mast and lighting solution, but we are also a manufacturer of tactical vehicle to the defense industry and government agencies in Israel and outside of Israel. This is actually the fastest growing subsidiary we have as of now, and we see great result there. The additional second acquisition that we've made is a company called Tiltan, which is a software company, originally specializing, again, in the defense sector, providing solution for GPS denied navigation, mainly for drones and other vehicles and let's say robotic systems worldwide. It's a company supervised by the Israeli Ministry of Defense, but is selling all around the world. A company called ITS, which is a superior engineering and assembly line provider for the defense industry, established 35 years ago, and is considered one of the highest ranking in Israel. And ITS has a subsidiary called Positech. Positech is an electromechanical solution provider, basically that provides the neck for many of the rotating systems worldwide, mainly for radars, tracking devices, anti-missile systems, and so on and so forth. The last 2 acquisitions or 2 subsidiaries that we have, one of them is called Nimbus. It's relatively the recent acquisition and the smallest one. It's a company that deals with drones, imports and sells drones in Israel to the Israeli defense ecosystem, but also provides guidance, instructions, and other services to those drones. And the last one is that we also initiated and sponsored a SPAC, which is SC2, which is its own publicly traded vehicle looking for an acquisition. And the great thing about that is that it's a non-dilutive way of adding value to T3 shareholders, because the SPAC has the ability of acquiring a significant business, a couple of $100 million and north, but it has its own publicly trading stock. It can raise its own money. It did raise its own money without diluting the shareholders.
Got it. And we can go back to the SPAC in just a few minutes. It is an interesting part of the balance sheet and capital structure, but I believe you guys just announced a recent one last week, Project 35. Can you give us an update on that?
Right. So Project 35 is a very interesting company. It was founded by a couple of senior executives in the Israeli defense ecosystem. used to work for Rafael and for Elbit and for Israeli aerospace industries. They founded their own company, Project 35, and Project 35 does two things. First, it provides services to the defense industry, mainly engineering and assembly, very similar to ITS. We like those companies. They are a very good source for products, for services, for clients that we can cross-sell them out of our other products of our subsidiaries. But more importantly, they also provided two anti-drone solutions, and this is what we liked about them. They developed their own drone, which is used to intersect other drones, but they also developed a unique system, not commercial yet, hopefully to be announced in the next couple of months, which is a very significant player in the anti-drone world. As we all know, drones and anti-drones and related robotic solutions are getting more and more important in the modern battlefield.
Right.
And for us, it's important to diversify our holdings with assets in those fields. All of our companies are revenue generating. Most of them are profitable by themselves. They're mature businesses that we buy because we think they can grow even further.
Well, let's expand on that. Now, you guys are still in acquisition mode, I believe. Maybe talk about what's the acquisition criteria, what size, what are you looking for on future M&A activity?
So I think I mentioned earlier, we started the year with 5 acquisitions, and we thought we are going to do this year maybe 1 or 2, and that's the current pace because we want to spend a lot of time on integration. Criteria-wise, we're looking for revenue-generating businesses, usually family-owned, doing somewhere between $10 to $100 million in revenue. Our first and most important criteria is we see growth potential. There is something there that we believe that we are ahead of the growth curve, and we can help and accelerate that growth to the market. And this is the most important thing. They could be losing money. We prefer them not to, but we want to see there is a demand for the product, for the services, and there is a big upside. So we are looking for revenue generating businesses, hopefully profitable, significant growth ahead of them, mature managements, although we do have the ability of helping them to grow even further. And we want to see some cross-sell synergies within the group, meaning with their product, we can sell it to our existing customer base. We can expand internationally. Those are the critical points that we were looking to identify.
Are you looking at North America, European Union for these acquisitions, all over, or where specific?
Although most of the operations currently is in Israel, most of our sales are geared towards international markets, directly and indirectly. Most of the sales that our group is doing are through the integrator, through the tier 1 providers are done internationally. So if Rafael is selling Iron Dome to European country or to the US Navy, we are selling through that. Our generator Tiltan is selling 85% of his sales are outside of Israel. And so are all the other providers. So indirectly, we are currently an international company. The base and the operations, yes, they are in Israel, but we're selling globally, and we're looking to increase our global footprint. We have identified several interesting acquisitions. We're looking to start our operating base in the US and grow the market even further there. We see all the initiatives the current administration is taking, not just in drone. Obviously, drone is a very well-known now, but we see other initiatives that we think we should be and we can be part of. So we are looking to, by the end of the year, to have a significant operating base in the US to grow our presence there.
Got it. That sounds like a great plan. Let's go back to that SPAC for a second. It's an important part of the story where it's a SPAC you sponsored in 2025. There's 172 million of cash in trust to make acquisitions, like you indicated, but sort of explain the dynamics there. Is it once they make an acquisition, is it something you hold, or can you sell it to find other acquisitions, or what's kind of the plan there?
So there were several good reasons to do that. So it's a relatively rare animal for a public company to sponsor a SPAC, which is by itself a public company. So number one, as I mentioned earlier, SPAC is a vehicle that allows to do significant acquisitions without diluting our shareholder base, meaning it has its own pocket and its own sources to do that. But on the other hand, it brings a lot of value. Once there is an acquisition, we as a sponsor get somewhere between 20 to 30% of the DSPAC company, and that by itself could be a great source of value for our shareholder. We are relatively open as to if we hold it or sell it. I think it's a matter of what this SPAC would look like and how it's going to behave. But both ways are going to be valuable for our shareholder base. It's either being part of our balance sheet and adding significant value there, but also could be a great source for cash, for our cash flow, so we can sell out and liquidate through over time. And again, this is a great way for us to raise money by selling those shares of the SPAC without diluting our shareholders. So we do not need to go back to the market and raise money from our shareholders and diluting them, but we can sell that asset. So all those parameters led us to believe that this could be a very interesting and lucrative way. On top of everything, there is a good reason. On top of that, we saw very good opportunities that T3 was not a good fit for them, but we think a standalone business or a standalone public company is a good way for them to do that. And this is all the reasons why we did that.
No, it's great. It's a great asset to have and a great kind of multi-use situation. So before we get into some company financials, let's just talk about the whole defense industry for a second. Global defense spending could reach 2.9 trillion. We know the U.S. has a budget of 1 trillion. Any thoughts on that?
There is a very interesting and important Morningstar report a couple of years ago showing that the world is in its historic low number of airplanes and battleships and tanks and ammunition and missiles. And I think that there is a cycle that every time we get to the low, those wars start somewhere in the world, and the world realizes we need to shape up. Last year, the European nation announced a $800 billion acquisition of defense-related assets. Obviously, the U.S. administration is keep rising. As opposed to a fashion or consumer goods, number one, defense, everybody think they understand what it means. In biotech, it's not the case. And number two, there is no real sensitivity to price. If we need the tank or the airplane or the missile, we would just go and get it. I think we are not even close to being at the top. I think it's that trend is going to increase. I think it's not just a matter of scale. I think it's also a matter of what people are buying. I think the robotics, autonomy, solutions is going to play a bigger role. Again, I think today it gets a lot of the headlines, not necessarily the capacity. Capacity is still with tanks and airplanes and submarine, the good old way of winning wars. And I think whoever wants to win a war needs to have skill. That's number one. It's not just to have a sophisticated weapon or just a sophisticated way of flying a new drone. It's also, you have to have skill. And we see that in Ukraine, the number of drones and anti-drone solution being tested there on daily basis shows that you have to have something innovative, but you have to have a lot of it. It's not just enough to try. I think that defense as a sector is going to outperform the overall indexes for the next few years. Defense usually is an era that is delayed. Once you see a war, it takes a couple of years until it's translated into the balance sheet and profit and loss of the companies. But once it gets there, it's a very long cycle. It's not a cycle that starts and ends like few other trends that we saw, like treasury deals or cannabis. I think, again, defense, although it's delayed, once it's there, it's long. So that's why I think the defense as a sector is going to outperform the index for the next few years.
You guys are in a great spot. Like you said, we still need the tanks and the planes, but I think they're saying now the growth will come from, they call it low altitude defense, which is, drones or small footprint defense, robotics, autonomy, that sort of stuff. So you guys are right in the middle of those growth areas in the defense spending, I believe. Just specifically on the company, you gave revenue guidance of about 26 million US for 2026 calendar year. And kind of what's driving that? Has anything changed in that projection?
We're going to update that, I think, in the next few weeks. Obviously, the acquisitions is a good way or a significant way for those adjustments, but we also see some updates in the market. We see bigger demands for our services and products. But again, you have to remember, defense is a marathon. It's not a sprint. The time that you see the demand increasing until it translates into increased revenue, it takes time, because usually the government or the Ministry of Defense, they need to tender it. They need to think of what the requirement does. They need to engineer it, someone needs to design it, and then it comes to the manufacturers, and then you have to do the purchasing. The cycles are long. The long term in defense, I think, for us in specifically is promising, and we see growing demand for that.
Yeah, there's an old saying in this type of business: the revenues come in slowly, but they go out slowly as well because it's these long-term contracts. In terms of profitability, I know you said most of your subsidiaries are profitable or close to it, but you have a lot of corporate expenses. Talk about 2027, 2028 in terms of EBITDA profitability or net profitability. I know you guys aren't giving guidance yet, but just generally speaking about future profitability.
So sure. So 26, I think I mentioned earlier, is the integration here. During that year, we see obviously increased expenses in our administrative and general expenses in the corporate level. We need to hire more people. We need to standardize the systems, ERP solutions. We need to invest in the infrastructure for that company to grow. I believe during 27, both the increased revenue and the stability to get some kind of an equilibrium, a steady place for the company would allow us to move somewhere during the year. I'm not sure exactly when, to become profitable. And I think 28 would take the next phase of increasing that. A lot of that is a matter of understanding, or in a way trying to pick the specific subsector within the defense. Defense is a huge thing. Some of it's industrial companies, some of them are SaaS software companies, some of them are pure AI, and some of them are some kind of a hybrid. In a way, we're trying to be an ETF of that sector, trying to balance things and to diversify, not just hold one asset just because we think everything is needed for successful from the modern battlefield. So we're trying to hold assets of different kinds.
Okay, that sounds good. We're almost out of time here. Any closing comments or thoughts before we let you go?
So first, thank you for having us. I really appreciate what you guys are doing. I think I'm very bullish on the sector. As I said, I think the sector by itself is a very good place to be the next couple of 2-3 years at least, probably longer. It's a long-term play. It's not a sprint. People investing in that sector need to be patient. They need to understand geopolitics. They need to understand the world economy. A lot of the different things are out of the hands of the specific companies, and they're affected by that. And not just to mention the stock by itself, but I think this is a good place to be as part of a bigger portfolio.
No, you're right. It is a good long-term story. And just I'll bring up that our price target of $1.50 incorporates a 10-year discounted cash flow. So we're looking at what can happen 5 to 10 years from now with this portfolio of businesses. And that's obviously worth a lot more than today's stock price. Okay, well,
Definitely.
Great. Thanks, Manny. Thanks for your time today. To read all of our reports, investors can go to scr.zacks.com, as well as our social media channels. And if you want more specific information on the company, you can go to their website at t3dfns.com. That concludes our chat. And thanks, Manny.
Thank you so much. Thank you.